Well, everyone, it's happened again. The stock market's crashing. If we look at the stock heat map, it's a sea of dark red with only a few pockets of green amid the downturn. We can see that the big names like Meta, Google, Apple, Oracle, Walmart, Uber, JP Morgan, Booking Holdings, Starbucks, Intuit, Nvidia, Fortinet, Broadcom, and many more are all down 4 or 5% on the day. Meanwhile, there are some companies that are doing even worse. ASML, CrowdStrike, and ServiceNow are down 7%. Palantir has fallen a staggering 10%, and Tesla stock has plunged 15%. Marking the worst day specifically for the Nasdaq since 2022. The Fear and Greed Index is showing that extreme fear is gripping the market, and it appears to be intensifying by the minute. This market sell-off is part of a broader downturn we've seen over the last month or two. Tesla is down around 50% from its all-time highs. Palantir is down 36% from its all-time highs. Nvidia is down 26% from its recent highs. Google is down around 20% overall. Meta is down around 20%. Amazon is down 18% from its all-time highs. Netflix is also down 18%, and CrowdStrike is down 30% from its all-time highs. So in this episode, we're going to have a look and see what is going on, see what has changed. We'll have a look at my portfolio and see how that is doing, and we'll have a look at some of the companies that I own and some of their fundamentals and see how they're being affected. Then I can make a decision on what actions to take. To analyze the fundamentals of these companies, I'll be using my investment analysis platform. The link is in the description if you want to try it out for free and follow along. Now let's jump straight in. According to Wall Street's analysis, the current sell-off is largely driven by recession fears. Investors are worried that rising tariffs could drive prices up and that will slow demand and there will be a slowdown in the economy. This concern has pushed stock prices back to the levels we saw in September last year. So all the gains in the S&P 500 over the last half of a year have been wiped out, despite the recent earnings releases and the growth in revenue and earnings of the underlying companies that drove the stock price increases in the last 6-month period. And this is all based on the fear of a recession. We're not even in an actual recession. However, it's not all doom and gloom. There are some winners in the market. Going back to the stock heat map, we can see that investors are exiting growth stocks. At the same time, there is an increased interest in the defensive sectors like pharmaceuticals, energy, utilities, communications, and consumer non-durables, sectors known for their dividend yields and stability. Now, market anxiety over recessions is nothing new. Fears of downturns emerge every few years. Here are some posts from 2024, 2023, 2022, and so on, talking about a potential recession. There was even an article back in 2018 talking about fears of recession arising from tariffs during Trump's first term as president, which I find interesting. The point I want to illustrate with this is that the fear of a recession or market downturn doesn't always materialize into one, and the market can sometimes overreact. That being said, I do think recessions will inevitably happen. The economy is going to have periods of negative growth or slowdowns at some point. There have been dozens of recessions over the last century, and each time the cause, duration, and severity of the recession has been different. It would be great if we could predict when these recessions were going to occur. It would be amazing if we could perfectly time the top and the bottom of the market. But I think that there are so many factors that can impact whether we go into a recession and what the duration and severity of the recession will be that make it almost impossible to predict. Warren Buffett doesn't even claim to be able to predict or try to time the market. Here's a quick clip from him.
The interesting thing is, obviously, we haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had. We have never made, Charlie and I don't think, in all the time we've worked together, and I'll tell you something later on maybe about how learning takes place, but we have never, I don't think we've ever made a decision where either one of us has either said or been thinking we should buy or sell based on what the market is going to do.
No.
Or for that matter, on what the economy is going to do. We don't know. And the interesting thing is, sometimes I get some credit someplace for the fact that, how wonderful it was that we were optimistic in 2008 and when everybody was down on stocks and all that sort of thing. We spent a big percentage of our net worth at a very dumb time. and I shouldn't say we, it's I. We spent about $15 or $16 billion, which was a lot bigger to us then than it is now. We spent it in the last few weeks. There were a period of 3 or 4 weeks between Wrigley and Goldman Sachs and General. At a terrible time, as it turned out. I mean, I didn't know whether it was going to be a good time or a bad time, but it was a really dumb time. And wrote an article for the New York Times and Buy America and all these things. Well, if I'd had any sense of timing and waited 6 months until, I think the low was in March, and in fact, I think I was on CNBC maybe that day or something, but I totally missed that opportunity. I totally missed, in March of 2020. We have not been good at timing. We have been reasonably good at figuring out when we were getting enough for our money, and we had no idea when we bought anything. Well, we always hoped it would go down for a while so we could buy more, and we hoped even after we were done buying and ran out of money that if it was cheap, the company would keep buying, in effect taking our interest up. I mean, that's stuff you could learn it in fourth grade, but it's not what's taught in school. And I mean,
So I don't try to time the market. If I take out my money from the market, there is a risk that I'm potentially taking my money out of the market at the bottom, that I miss some of the days where the market is going up, and I potentially have to buy back in at a higher price than where I exited. So I actually try to keep my money in the market as much as possible. Here are some interesting graphs. These cover the best days in the market. In the pie chart, we can see that 50% of the best days in the market over the last 30 years have been in bear markets. So if we had to take out our money in a bear market, not only are we potentially going to not be able to time the top or the bottom, but potentially we're also going to miss out on some of the best days in the market. Looking at the bar graph, we can see that if we missed just the 10 best days, our portfolio would be 50% lower than if we remained fully invested. It would be over 70% lower if we had missed the 20 best days, and over 80% lower if we missed just the 30 best days. Now, while stock markets can suffer short-term declines, history shows that the market has recovered and reached higher heights, and that investing in the dips have provided improved returns in the long run. And where the market overreacts, it can create great buying opportunities where stocks are even cheaper. For me, my investment horizon is long-term. I don't need the money I'm investing in the next 12 months. I don't expect to need it in the next 5 years. Ideally, I want to keep it invested over, say, the next 30 years. So for me, with my investment strategy, if I need to wait through a recession, I'm happy to wait. In fact, it actually gives me an opportunity to buy great companies that are a better place to handle a recession at even cheaper prices. Now, here's my portfolio. I want this channel to be transparent to show you how I'm performing in the good times and the bad times. I don't expect to outperform the market in every period, and I fully anticipate there will be periods when my portfolio lags behind broader indices. However, my goal is to minimize underperformance during market downturns and maximize performance during bull markets, with the ultimate objective of outperforming the market over the long term through strategic stock selection. My portfolio is heavily concentrated in what I believe are high-quality growth stocks. Because of this focus, my portfolio has experienced greater volatility compared to the broader market during this recent downturn. While this can lead to short-term fluctuations, provided I have done appropriate research before investing in a company, I can remain confident in my investment thesis and the fundamental strengths of the companies that I own. So here I can see a screenshot of my portfolio a few weeks ago. We can see that we're sitting with total gains of $28,000. Close to 40% gains for the total portfolio. Now, here is my current portfolio. We can see that total gains have dropped down to $15,000, which is around 20% gains for the total portfolio. I have been adding to my portfolio as the prices of some of my stocks have been dropping. I have added around $6,000 to Google after the stock price dropped by 10% from Google's all-time highs. I've also entered into a position in Medpace for $4,000. That was around 2 weeks ago. Google then dropped a further 10%, and I added another $3,000 to the position. So I have been adding a fair bit to my Google position recently, as I think it's undervalued. By adding to this position, it has reduced my return percentage. So where this was around 60% earlier this year, with the drop in the stock price and dollar cost averaging into this position, I'm now sitting around 8% gains. The market has already gone down. I've temporarily lost some of my gains. That sucks. Whether the market goes down further, I don't know. I see this all as just temporary price action. What we need to remember is that behind every stock there is a company, and in the long run is the performance of that company that is going to drive the performance of the stock. So we need to have a look at the performance of the companies we own and make judgment calls about their future growth prospects. Looking at Google, we can see that in the past the company has done well. Google grew their revenue in the 2008 recession, and it grew during the 2020 lockdowns. Google has a strong balance sheet, better than most of the companies in the S&P 500. I don't expect the company will go bust if there is a downturn or a recession. Advertising spend may see a pullback during a recession. It may not. If it does, this will impact search and YouTube revenue in the short term. Long term, I expect online advertising revenue will increase. Another major revenue stream for Google is cloud services. These can sometimes be multi-year contracts, so customers can be locked into the service line. It is also very difficult to switch from external cloud hosting to doing something in-house or switching to another provider. I expect cloud revenue will continue to grow and not really be affected by a recession. Google's stock price has dropped around 20% from its peak. I don't think the performance of the business is going to drop by 20% if there is a recession, so I expect that the price ratios are going to improve and the stock will effectively be cheaper and less risky to buy after this price drop. A similar thing with Meta, they have been performing well. They grew revenue in lockdowns. They have a strong balance sheet. I don't expect Meta will go bankrupt from a recession. Their advertising may take a slight hit if there is a recession, but I expect this to be short-term in nature. Meta's stock price has dropped around 20% from its peak. I don't think the performance of the business is going to drop by 20% if there is a recession, so I expect that the price ratios are going to improve and the stock will effectively be cheaper and less risky to buy after this price drop. A similar thing with Amazon. They have been performing well. The company grew in the 2008 recession and it grew during the 2020 lockdowns. They have a strong balance sheet. I don't expect Amazon will go bankrupt from a recession. A core part of their business that I invest in Amazon for is AWS. Similar to Google's cloud service line, I expect this will continue to grow and not really be affected by a recession. Amazon's stock price has dropped around 20% from its peak. I don't think the performance of the business is going to drop by 20% if there is a recession, so I expect the price ratios are going to improve and the stock will effectively be cheaper and less risky to buy after this price drop. Looking at a company like Dexcom, they are a leading company in the continuous glucose monitoring market, providing essential technology that helps diabetics track their blood sugar levels and prevent long-term health complications. The company also benefits from a subscription-based revenue model with Dexcom One Plus, which adds more stability to its cash flows. Dexcom grew their revenue in the 2008 recession, and they grew their revenue during the 2020 lockdowns. In the event of a recession or rising inflation, I expect Dexcom's devices to remain a high priority expense for users, making the company's revenue more resilient compared to other sectors. Essential healthcare products like these are often amongst the last things consumers cut from their budgets. Dexcom's stock price has dropped around 25% in March alone. I don't think the performance of the business is going to drop by 25% if there is a recession, so I expect that the price ratios are going to improve and the stock will effectively be cheaper and less risky to buy after this price drop. In summary, I think the companies in my portfolio are fundamentally strong, high-quality companies that are capable of weathering a recession long-term. I'm not going to try and time market swings. I think this can lead to suboptimal returns. Instead, I'll be keeping my eye out for any weakness in the market, looking for quality companies and seeing if any of them are trading at bargain prices, and maybe doing some more buying over the next few weeks. I think it's these periods of weakness in the market that can be the best buying opportunities. So you have to be patient and you have to be able to identify opportunities when they present themselves to buy quality companies at bargain prices. A quick example is when Meta's stock price dropped by more than 50% a few years back. If you'd entered a position during this period of uncertainty, you would have made over 100% on this investment. If you're interested in following my investment journey and seeing the stocks I buy in the coming weeks and months, hit that subscribe button. Also, if you enjoy this video and want to see more insights on market analysis, stock market crash updates, and investing strategies, give this video a like and subscribe. I'd also love to hear what stocks you're watching. Drop your thoughts in the comment section below. That's it for this video. Thanks for watching. I'll see you in the next one.